Welcome to the Working Without Waste podcast, powered by ERC Midwest, the podcast that's all about sharing ideas and stories that can increase productivity and decrease waste in your business and personal life. Today's episode features Sequoya Borgman, the founder and managing director of Borgman Capital, a private equity firm that's based in Milwaukee. So Sequoya, welcome to the show.
Yeah, thanks for having me. It's good to see you again.
Yeah, it's good to see you. We've had a chance to do a podcast on another podcast that I do. So when we were looking for ideas on how we could share knowledge with business owners, I definitely wanted to bring you on the show so that people could learn about you and could learn about private equity as well.
I'm excited to be back.
Yeah, well, let's get started, Sequoya, and just kind of give us sort of a brief bio on you and Borgman Capital, and then we'll get into the nuts and bolts of private equity.
Sure. So my background is primarily public accounting. I was a CPA partner in large public accounting firms. First 20 years of my career, got a master's in accounting out of school, and then started with one of the large Big Five firms at the time, but really focused on a lot of the transaction, M&A, and private equity side of the business. So after working for firms for 20 years, decided to leave and launch my own in 2017.
And what was it that made you want to take that step? It sounds like you had a very successful career in public accounting, and starting anything from nothing is hard, and starting a private equity firm where you have to raise money and you have to find companies to invest in and stuff sounds like a lot of work.
It's actually been a lot of fun. I wish I'd done it about 10 years earlier than I actually did. I think I was one of those mid-career executives ready for the next challenge, and it's been a blast, really.
Well, so let's start with the basics, Sequoya. I find that a lot of people may not exactly have an understanding of what private equity is, and particularly the differences between private equity and people hear venture capital, people hear investment banking, and I think sometimes they all get lumped together, but they're all very, very different. So could you help us just kind of understand the mechanics?
Yeah, sure. There's, as you said, really private equity gets a bad name because there are so many different types of private equity, and some are more turnaround type firms. Others are venture firms. They're early stage investments, and then there's more established traditional leverage buyout type private equity, which is really our focus. And private is really, rather than using public markets to buy companies or grow and expand markets, you use private funds, private investors to buy companies, non-publicly traded companies, and really and grow them with private funds. So that's really the thing. And leverage buyout means that to really goose the earnings, you use some leverage. You use some bank financing for part of the acquisition, and then less equity to buy the company. And that's really what we're focused on, is traditional leverage buyout companies.
Okay. And so leverage buyout, I think, like you mentioned, sort of sometimes the stories that people know about private equity are the ones that they read in the paper, or a politician brings up for greed or something. I'm thinking back when Mitt Romney was running for president, he had worked in private equity at Bain Capital, and that became, even though I'm sure Bain Capital did and does a ton of great work, it definitely became something that was a negative. There was a negative perception built around it. So
yeah, what Bain and Romney and a lot of the stuff that you hear about in the news, RJR Nabisco, the stuff in the 80s where these big industrial conglomerates, the private equity was breaking up. Really, they were taking these big companies and selling off divisions and creating value for shareholders, and those companies had a lot of waste on them, a lot of corporate overhead, a lot of glut, and truthfully, they cut salaries, cut people, reduced facilities. They did a lot of stuff that people still think of private equity these days. There's not a lot of these big GEs left around anymore, so that's not really what private equity is focused on. But you really still think about the Gordon Geckos and those types of firms when people hear about private equity, but that was almost, I don't know, 35, 40 years ago. Most of those corporate breakups were going on. Now it's more buy and build strategies. So a lot of lower middle market companies, founder-led, family-run businesses that have got to a certain scale, and really nice businesses, been around a long time, established business models. But to get to the next level, they really need some outside equity to come in, help them either with a roll-up strategy to buy more businesses in that space, or organically grow through adding regions or adding more experienced management team. All the stuff that outside equity can really help with. That's more what private equity is focused on these days.
Okay, so I want to get into that a little bit deeper, but before we do, I've got just sort of two fundamental things that I wanted to ask you about too. One is, in order for a private equity firm to exist, they have to attract money from investors, as you mentioned, private investors. In your case, they have to find money to invest, and then they have to find companies in which to invest. So can you just walk us through how you and your firm have done both of those things?
Yeah.
Covered both sides.
From the equity and investment standpoint, there's really two models. There's a model where a firm will go out and raise a fund, say $100 million, $200 million fund from institutional investors, high net worth individuals, family offices, and they'll pool those funds together, and then they'll go out and buy 10 or 20 businesses with that fund. That's one model. And then the model that we use, we go and find the business, and then we raise the money from really the same pool of investors, high net worth individuals, family offices, and smaller institutions really is what our focus. But we find the opportunity, and then we raise the money. So from our standpoint, the hardest part these days it's been a seller's market. Even with COVID and the recession, what we're going through is really good companies are trading for high multiples. And if you find those really good companies and you get them, you negotiate with the seller a reasonable multiple, kind of a win-win for the seller and for the company post-transaction, it's a lot easier to raise the money than to raise the money up front and then have to go out and try and find those businesses, because finding the businesses are the hardest part.
So it's more, so if I get you right, raising money for each company that you invest in maybe keeps you focused more on finding good companies rather than just deploying.
Right. We don't have a pool of capital that we have to deploy. So if there's not a good opportunity, we don't have to do anything. We can kind of wait through downturns. We can wait through kind of the top of the market as well. We can be very opportunistic when opportunities come along, but we don't have to deploy any funds. Where if you have a fund, so you just raised it in 2019, you really only have 2 or 3 years to deploy that fund, or else you have to return those funds to the investors, and that'll dilute your IRR for your fund. So you really don't want to be in that situation.
Okay, so let's get into the weeds here. You use the word multiple, and I find that having bought a lot of companies myself and sold one myself, I have a pretty good idea of how companies are valued and how to position a company to get an appropriate valuation and things that get looked at. But what a lot of people, I don't think, they've never been through it before, so they don't know what some of this stuff even means, and they don't know what they should be looking at. So let's first talk about multiple. When you say a multiple, what is that?
It's usually a multiple of cash flow or EBITDA, depending on how capital intensive of a business it is. That's how most lower middle market non-venture deals are priced at. I mean, there's other ways of valuing businesses based on assets or some type of discounted cash flow calculation, but we really look at a multiple of EBITDA for the most part.
And I found that, at least in my experience, most private equity firms are looking at that rather than discounted cash flow and some of the others. What's the reason for that?
Well, really, it's the leverage that we use. For us to buy a company, we're going to use some bank debt or mezzanine debt to help buy that company, and we need to be very, very confident that company will maintain that cash flow to service that debt. So if you use discount flat cash flows, you're really counting on some future projections of earnings. And every seller, I'm sure you weren't like this, but every seller will tell you that the business is going to take off as soon as you buy it. Where we're much more confident on what the company did in the past, and as long as we can maintain that cash flow and service our debt, it should be a really nice investment for us and our limited partners that invest alongside of us.
Okay. And when you go in, so say you find, well, first of all, how do you find companies? What is the way? What are the ways that you use to find companies to potentially invest in?
Well, the best opportunities come through our network. People that we know somebody that wants to sell their business. They introduce us early in the process, and we get to know the owner. We build a level of trust, and once we feel like we've come to a reasonable valuation, we can go forward. Those are the best opportunities. I'd say the majority of the opportunities come through either investment bankers and brokers. We look at a lot of those where they have been hired by the seller to put a book together and really go out and market their business for sale. That's probably where the majority of our opportunities come. And then we hire marketing and outgoing cold calling companies to call in businesses in various segments that we really like. So we use a lot of different ways to draw up leads. But again, the best leads come through our network and our COIs, the bankers and attorneys and accountants, and really trusted advisors that know the business owners. They know before they're ready to sell, and we get in there and really, again, it all comes down to trust. The business owner wants somebody that's going to take care of their business after they sell, and that's really where we gain the level of trust with them to let them know that we want the best for their business. I mean, if their business continues to thrive and we're able to grow it, that's really what's best for our investors and everybody involved, and the employees and really all the stakeholders.
And in your experience with, you said small to mid-market companies is where you focus. First of all, put some parameters on that for the people that are listening. What does that mean?
I'd say under 100 million of sales, really a couple million to $10 million of EBITDA is really the focus from a cash flow standpoint, although we've looked at stuff smaller than that, stuff larger than that. Once it gets over 10, 15, 20 million EBITDA, those really companies are being sold to big strategics or larger private equity firms outside of our market. And they're going for a lot higher multiple because there's less risk in a business like that, a lot more infrastructure, less risk for the investor. And that's not really our focus. We like the owner-operated businesses that you can really upgrade the infrastructure, upgrade the management team, and really add some value.
And of course, the vast majority of businesses that are out there are generating EBITDA below $10 million.
Correct. Yeah. Really, I mean, the majority of businesses are small businesses. I'd say under $2 million of EBITDA. I mean, we see a lot of those. So there is opportunities in that space, but you really need a platform to start with, and then you can buy those really small $500,000 to $2 million EBITDA businesses as well.
So you mentioned, like as an add-on, in other words, you're saying.
Correct. Yeah.
So you mentioned, that you bring value. You mentioned sometimes having to build a management team. There, all businesses come in all sort of sizes and shapes. Some people business owners want to sell and then move on to something else in their life, and others want to sell a portion of the business and stay on to run the business as well. At least that's been my experience. Is that so? Kind of, what's sort of spectrum of people that come in that you have conversations with? And I just want to give everybody sort of an understanding of where you might have to be in the process to at least consider a conversation with a private equity partner.
So there's all different types of sellers. I mean, the ones that you talked about, like yourself, where maybe you sell a portion of your equity, you partner with somebody to do a roll-up strategy or really reinvest in the business to grow it more than the business owner could do on their own or with their own capital. Those are great opportunities. A lot of times then the owner will run it for another 5 years or so, and then it'll ultimately, once the roll-up strategy, the add-ons have been consummated, then it'll be sold again to a larger strategic or a larger private equity firm down the road. I mean, that happens a lot. I mean, you really need a owner that kind of can evaluate themselves and know that they need help, and they appreciate outside advice. They appreciate having a formal board. They appreciate other people's thinking about strategy and risks, and they appreciate more than just the equity. It really needs, because if the owner is not going to be able to be introspective and really understand that they're giving up some of the control, and I mean, anytime you take somebody's money, there's strings attached. It's not not like selling your house where you walk away the next day. So that takes a particular owner. If there's an owner that's just looking for some equity to kind of do an acquisition or grow the business, but doesn't want the outside advice or the true formal board, that's going to be a difficult transition. They're better off selling the entire business. If you're not willing to partner with somebody and truly hand off some of the kind of the control, the day, not necessarily day-to-day control, because private equity firms, we're not operators. We're not in there managing the business on a day-to-day. The owner, CEO, president, they're making those day-to-day management decisions. But whether or not you go forward with a large capital expansion or add-on acquisition or a key hire, those types of things, if you're not comfortable having other people give you advice, then it's probably not the best thing for you. So that's one seller or buyer. There's management teams. Sometimes the owner is ready to retire. They want to sell it to their management team because the management team's been loyal. They've been there a long time. They know the business better than anybody, but they just don't have the funds to buy the business. We'll partner with the management team, we'll bring in the equity, and the management team can run the business after the transaction. And we'll put together some equity incentives so they can earn more equity than if they tried to just buy it themselves. And then the third type is really the owner that he's usually late 60s, early 70s, maybe even 80s, kind of held on as long as he could, and he's ready to, either his wife is encouraging him to move to Florida, or he really recognizes that he doesn't have the management team in place to take over for him. And then usually they'll sell 100% to somebody like us, and then we'll bring in a new management team to really run the business.
So you mentioned risks in there, and having owned my own business for a lot of years, business goes in cycles, right? And you can be feeling really great about your business, and then something can happen and you can be feeling very scared about your business, whether it's things that happen just to a big client or something, or whether it's the economy or whatever. And that's why so I guess my thinking was always like, I should always be positioning my business so that it could be sold, because I don't know when the point is going to come where I don't have an appetite for the risk anymore, for example, or I've got these other family things, or all of these things. So when people do come to you, are they, generally speaking, are they prepared? They know how to have a general reasonable value for their company. They can support it with numbers, and everything sort of ties out and squares up and everything. Or is it what? I'm sure you like it when it's like that. Is that what happens most of the time? Are people prepared or not?
I'd say no, and normally they're not prepared, and it takes a lot longer to get prepared than most people think. Really, the biggest impediment to selling a business a lot of times is the owner, because they're so involved in that business. They've been in there since day one. They've run every facet of that business. They know it inside and out. And those, a lot of times that's not institutionalized into the business, or they haven't hired really strong management teams that they can trust and delegate parts of that business to. So it takes several years for a business owner to kind of transition that. And a lot of times they look at that as additional costs, so they're going to get less value out of the business. But if those people that they bring on and those systems that they invest in, they should get a return on those. The business should grow more. The business owner can really focus on what adds value to that business. They can be a lot more strategic. I mean, if you're running a $5 million business, lot of times as a business owner, you're doing everything. You're the CFO, you're a salesman, you're the HR, you name it. But when you're a $20 million business, sometimes the business owners are still doing that, but they don't have time to sleep if they're still doing all that kind of stuff. And they haven't delegated. So we're going to have to do that when we buy the business. So we'll model that into our return calculations. So a business owner will get more value if they start thinking of that. And then do what's best for the business. I mean, sometimes it doesn't make sense to sell the business. You can bring on a really strong professional management team, a professional president. If you want to spend less time in the business, maybe you don't pay yourself as much, you pay this management team, but you can spend half the year in Arizona or Florida if you have a really strong management team that can manage the day-to-day operations, and then you act as a professional board. I mean, you know the business, so you don't always have to sell. I mean, I'd prefer if you sell, but I mean, if that's not the best thing for the business, I will tell the business owner. I mean, it's more important to be upfront and honest with the business owner than just try and get a transaction done.
You talked about at the beginning where you were sort of differentiating private equity of today versus private equity maybe 30 years ago or 25 years ago when there were these conglomerates that needed to be broken up. You said that you're sort of a buy and grow. That's your philosophy, buy and grow. So buy, invest, and grow. Can you give us some examples of how you've worked with a company that you bought and, you know, and the company is at one stage and without taking over the day-to-day operation of the business, which you said is not your expertise, how you brought, you know, additional value to that business and what happened as a result?
Sure. Yeah. Every business, I mean, not every business is a roll-up strategy. Some are just really nice businesses that can organically grow by focusing on sales and their markets. I mean, we have a food company that's done really, really well, phenomenally, really, by just filling out their volume. They had plenty of capacity, and we've really focused on how to scale that. We've looked at a couple add-on acquisitions, but those add-on acquisitions would actually dilute the return because the business has done so well. So those we have not done add-ons, even though we have some opportunities. We have a cell tower roll-up, a telecom business that we're actually, it is a roll-up strategy. We bought 4 of them since we started, and from small regional mom and pop owner-operated businesses, when you buy 4 of them, merge them together, I mean, we cover half the country now. Their resources are so much higher. The level of their management team and their financial resources, their systems, benefits, all that is just way above what they were able to do as a small regional player. And I mean, all their customers are now large regional customers. So I mean, that's a area where we would have to do add-on acquisitions for that strategy to work out. But it really depends on the business and what the business needs. Not all of them doing add-ons really helps their business, but some you have to.
That was a good point you made with the add-ons at the food company you talked about. So if I had you right, I want to make sure people understand. So the other businesses that you looked at that were in the food space and maybe could be complementary were less profitable than the present business, and as a result, if you bought the business as an add-on, it would actually take the value of the entire business down. Is that what you were saying there, or is there something else that I missed?
Yeah, that's the multiple that we would pay for these add-ons would be dilutive to the original investors. So there's really no point unless we were getting it for a bargain valuation. There's no point in doing that. If you're paying top premium price for a business when you already have a home run investment, it makes no sense. It does add some value long term. You have more infrastructure, less risk. Potentially, you could sell for a higher multiple, but there's no point in overpaying for that business.
Okay. And as someone who's had a long career in public accounting, where you focused for much of that career on private equity transactions, as I recall, and then with your own private equity firm, I'm wondering about your perspective on advisors to business owners and that are looking to sell their business or a portion of their business. And I'm specifically talking about accounting and legal, because a lot of people get business owners get, they get hooked up with an accountant and a lawyer sometime early in the development of the business. And they stick with those people because they're doing a good job and they're dependable. They know them, they're familiar with them. And then when it comes time to make a very, very big decision, maybe, with your whole future tied to it, maybe you're the accountant you've been using to do your books and the lawyer you've been using for, buy sells and stuff, for example, or other types of transactions might not be the right advisors for selling a business. Is that how do you feel?
I mean, I'm probably biased coming from that side, but I think it's very key that you get the right people that you can trust. Surround yourself with very good professionals that know what they're doing. You don't want an attorney that does corporate litigation and all kinds of stuff that maybe they're a great attorney and you great friend and you've known for a long time, but you want an M&A attorney that's all they do, and they do 10, 20 deals a year and they've done 100 deals over their career. That transaction is going to go much smoother. They're not going to focus on the small things that really don't make a difference, and they're going to make sure you get your premium price when you sell the business. And they'll help walk you through, because a lot of deals fall apart over little tiny petty issues that should not be an issue, but an attorney will bring them up or an accountant will bring them up, and then they're trying to make it show their value by doing that, but it doesn't. Their value is really to help the business owner maximize their proceeds.
Correct.
So you really want an accountant that's going to maximize or minimize the amount of taxes you pay in the transaction. Make sure you structure the transaction so you walk away with the most cash possible. You want an attorney that's done it, like I said, 100 times. You don't want an attorney that they're learning as you go through the process. All your advisors, you really want somebody that's been there and done that. And it's not, 99% of the time, it's not your advisor that you use on a daily or monthly basis.
That makes a ton of sense, because I know in my own experience there were, a handful of times or more where we were, negotiating and trying to close a purchase, and it felt to me almost sometimes like either the accountant or the lawyer, or maybe both of them, were more interested in not losing that account for their services than they were in really maximizing and getting done what the business owner wanted to get done. It just seemed very frustrating.
It is a bit of a conflict. I mean, that accountant's losing the work, that attorney's losing the work. They want to get paid as much as they can in this kind of last go through, and they're not always adding value. A lot of the times, like I said, the best value is a quick, easy, smooth transaction. Less stress on the seller, less stress on the buyer. Check all the boxes and everything, but still move forward and get through. Because something's going to come up on every transaction. There's something that's going to come up through due diligence, and how your advisors work through that is really telling. Got it.
So Sequoia, how do somebody wants to get a hold of you, learn more about your firm? What do you recommend they do?
Anybody can call me or send me an email or go to our website. I'm always available. I probably talk to or meet with a business owner every day or two, meet with a lot of COIs, and then also I meet with a lot of people that want to buy businesses. There's a ton of mid-career executives. I was kind of in that boat myself, of people that wanted take the risk to be an entrepreneur and buy a business themselves. And a lot of times they don't realize that if they partner with somebody like us, they can buy a much larger business. They can actually pay themselves something. A lot of times executives will go buy a business, but it's what they can afford. And those businesses don't have a lot of cash flow to pay themselves a salary. So, and then you have outside resources. You're not doing it by yourself. You're an entrepreneur. That's kind of the loneliest job there is being an entrepreneur or a business owner. Is you don't have a lot of people you can throw ideas off or talk through issues. At the end of the day, you have to make all the hard decisions for your business, and if something comes up, it's kind of buck stops with you. And we add some, not only an outside board, but we're available at 24 hours a day to talk through business issues as they come up.
Well, Sequoia, thank you so much for being on the Working Without Waste podcast today. It's been great to see you again. Thanks for explaining private equity to us. Again, Sequoia is the founder and the managing director at Borgman Capital, based in Milwaukee. BorgmanCapital.com, I believe, is the URL. So if you have any questions, because I know him, that he is generous with his expertise and his advice. So take him up on it.
Yeah, thanks for having me.